Welcome everybody. Thank you very much for being aboard our August powwow. This is Brian here. So basically, what we got is, as I said, I can unmute people, just myself and Paul. Paul Cottrell is aboard, so that we can just have an open-ended discussion about general trading, automated trading, and any questions you may have, where myself or whoever else can provide answers to the group. So we have the chat box right here. Just type away, and if you got questions or comments, don't be shy. Okay, so Paul, we were talking about just what's been happening generally. George has already made some mentions here about Portugal and Argentina defaulting, and banks. What's your view on that?
Oh yeah, I mean, these sovereign bonds are still very stressed, and Draghi, the ECB, and all of its different financial facilities, they got so many different acronyms, it's hard to keep up.
Yeah.
Are going to have to start doing their QE, their version of QE. They're going to have to buy these sovereign bonds to reduce the yield stress.
Yeah.
And I think that investors in the European market are going to be very risk averse.
Oh yeah.
Now, I remember when I did the 3D topology webinar.
Okay.
A couple months back.
Yeah.
And I was talking about the looming crisis. Not the one we did last night, but a couple months back.
Yeah, I remember that.
Now, in that, I was talking about how Geithner wrote that the banks were very stressed during the Lehman crisis.
Right.
All right, but Europe's banks fund so much more of the equity market than the U.S. banks.
Yeah.
So when the banks are stressed, they're even more stressed. If they're stressed because of their loan portfolio or their bond portfolio, that means that the movement in their equity market is going to be more violent.
Yeah.
Because it's more leveraged.
Right.
Than in the U.S. So when that happens, then there's probably going to be, when a big region like that, Europe, starts hiccuping, it's going to reverberate into the other equity markets.
Yeah, exactly. I'm just waiting for the big catalyst to come. Now, George has also said, is this a good time to short the Euro-US pair? What do you think, Paul?
Yes.
Anybody else got any comments? Just type. Go ahead.
The last I looked, the euro was at around 133. Now the euro, I think, is probably going to break 130.
Okay.
So that's how I played the euro one. Unfortunately, I have a position in this long.
Right.
But the pound, the BOE, the Bank of England, there's a lot of rumbling that they're going to start raising interest rates. So the way I played that game is that I'm longing the pound, waiting for the BOE to actually start raising interest rates.
Right.
Their home market, their mortgage market is starting to heat up.
Okay.
So there's some, and also the rumblings that are going on in the House of Lords is basically, in Parliament, is basically, perhaps the pound is actually suppressed, and that by raising rates, it will appreciate the pound.
Right.
So there's some pressure from the government. It seems to me that the Bank of England is not as sovereign as the Federal Reserve is to Congress.
Okay.
So the Bank of England, I think, is more pressured by political will, by the political powers that be.
Right.
So I think that the BOE is going to actually raise rates, and it's going to appreciate pound.
Yeah, there's a lot of.
Long position. So, but in terms of these equities selling off and deploying the currency market, at least in the short run, the pound is going to keep on going down.
Well, look at this.
Um,
Like this movement has just been getting
in the
pounded.
long run, it's going to go up. Yeah.
Yeah.
Now what you're showing is the euro.
Yeah, that's the euro U.S. dollar.
What I'm talking about is the pound. Right.
Oh, sorry. Right.
The
Yeah.
euro situation's different. The euro is going to be breaking 130.
Yeah. Now let me just get. Yeah, I thought it was the euro. Sorry about that. So let's say 3 month. As I was saying, if anybody else, well, yeah.
Right, so see, CD, right? So it topped out at like 1.71 or whatever
Yeah.
it was, and then it started to go down. There was a lot during that run up. It left the up the peak. During that run up, there was a lot of rumor that the BOE was going to raise rates.
Right.
So everyone was piling in and was waiting for Carney or whatever his name is to raise the rate at the BOE. It didn't happen, and then it started to depreciate. But in tandem, that was when you start hearing the stress going on in these banks in Europe. So I think in the short run, the pound is still going to keep on going down a little bit more.
Yeah.
But I do believe, just because their market is being heated up, that it's going to raise rates.
Yeah, I mean, there's.
If you look at the MACD, if you look at the MACD and the RSI, it's way oversold.
MACD, where is it? I'll just go with that period. Yeah.
And the RSI really shows you it's a really oversold condition.
Right.
So I really think that there's going to be a retracement once. Remember what the TED spread that I showed last night shows.
Okay.
When it rises, there's an event that happens, and then it abates, and then there's another 3 months, and then there's another credit event.
Right.
So there was probably a credit. There's something that's happened in the last 3 months here. That's some credit event. You showed one in the news article earlier that you showed. So something has happened just recently. All right. Something is going to creep up another 3 months from now, or within a 3 month period. That will make it worse.
Right.
The bad news hasn't seeped in enough into the market. When the second hit happens, then the sell-off on the euro is going to be.
There's a couple of comments that came in. Jeff says his algo is shorting euro US dollar at 1.3387. Okay, thanks, man. And then George asked, have you run the pound US pair on your software program?
Not recently, no.
No, eh?
But I could. I could. I haven't done it recently.
Okay.
Because I'm expecting the play that I'm doing right now for the pound is I'm waiting for Carney to raise the interest rate.
There is.
Actually, I was thinking about putting more contracts in the dollar cost average, waiting for him to do that, to do the raising of the rate. Now, if you look at the MACD, even though it is showing overbought condition, the MACD can drift more. Well, so what I'm thinking is the RSI is going to start coming up a little bit, all right, maybe to the 40-50 mark, while the MACD is still below the zero line.
Right.
I believe that the 200-day moving average is around 167, somewhere in there.
Okay.
If I remember, I'm not in front of my trading station, so but when the MACD is kind of drifted below the zero line for a little bit,
Yep.
and the RSI tests the overbought condition again.
Yep.
One more time, it's going to drift up to maybe 50. and then it'll come back down to 30 for the R side. Then I'm going to start putting in more contracts.
Okay.
That's when I think the retracement's it'll come back up. But I rode the 168 all the way to 171.
Nice.
Go in and out, in and out, in and out, in and out, throughout this. And then while I was doing that, because they didn't announce that they rose rates, I kept on going in. And then it started, so I'm locked in up at the top of 171.
Okay.
But I'm waiting for that it might break 167 for a little bit. But then I'm just gonna add more contracts and wait until he raises rates, because when he raises rates, that thing's going to 180.
Yeah. Let's see. Right. Nice. So there you go. I can never Vlad. Let me know if I got that right. I don't know if you see that in the box, Paul. 200 moving average. The British pound against the U.S. dollar 1.6707.
So I mean that's that's one position I have going, that I have. The euro, I think there's going to be a lot more stress in the euro.
Right.
You'll probably start here when the stress starts playing. I don't play gold. I don't do the gold game.
Okay.
What you'll see is you'll see the yen strengthen and gold go up. And that usually is highly correlated. The yen going up and gold going up are correlated, positively correlated. And so is the strength of the bond market.
Well, right here, there's this event where, if he's raising it, it'll be once wages rise enough. So, does that make sense?
Yeah, once wages rise enough.
Well, on this news story.
He doesn't have enough. He's basically saying, and I'm not really sure who he's trying to placate. Because there's a lot of people are saying, you know what, it should it's not just wages. Remember, the Federal Reserve has a dual mandate, an explicit dual mandate.
Right.
What that means is that it's about inflation, controlling prices, and moving towards maximum employment, potential.
Okay.
To the economy, reach to max employment, theoretical max employment.
Okay.
Usually in the United States, it's 5 to 6%.
Right.
Unemployment, if it's around 5 or 6%, that's natural unemployment. So, trying to reach the potential of the economy. That's the dual mandate of the Federal Reserve, explicitly. In the ECB, what's only explicit is price control. It has nothing to do with reaching full potential of the economy.
Yeah.
So I'm not really sure if that statement even makes sense to the whole charter of the ECB.
Right.
All they care about is price control, controlling inflation. Well, if the housing boom that I keep on reading on Bloomberg is true in England,
Yeah.
then he's gonna have to step on the brakes, which is basically raising rates, to slow down the bubble in assets in the housing market.
Yeah.
Now, the only rub with this is if something happens in Europe, that there's a credit, some sort of credit default or whatever, or stress, that will probably affect their equity, the pound's equity, England's equity.
Right.
And maybe the ECB will say, you know what, because of that, we're going to wait until we won't raise rates.
Right.
But the ECB, not the ECB, but the BOE,
Yeah.
and the Federal Reserve are zero bound.
Yeah.
I mean, you can't. I mean, you're so close to zero. There's not much that they can do to save the economy. So you almost kind of need the Federal Reserve to get a little bit of buffer,
Yeah.
raise the rate so they can lower the rate in the future.
Yeah. Well.
But who knows? I mean, anything can happen. I
Yeah.
definitely
Yeah.
think in the short term,
Yeah.
there's going to be more stress that will be here in Europe.
Yeah.
And who knows how that's going to affect the decisions of the central bankers. They'll probably be more dovish and hawkish
Right.
because of that, and hold off on any tight policy in the short term.
Right. Right.
But in the long term, the Bank of England is going to raise rates.
Yeah. Well, the thing is, has anybody got? We got one comment. Anybody else got any questions on this, or any other questions regarding just generally like where you're at in trading, where you need help in, or automation, or general trading strategies? Okay, Rakesh came back. Okay, so we'll address your comment in a minute, George, about British business negativity. Let's get other people involved here. So Rakesh asks, hi there, I'm a novice investor for considering using options as an investment strategy. What's your opinion on using the cover call? In your opinion, what are the advantages and disadvantages of using this strategy? I'm not an options guy. Are you an options guy, Paul?
No.
Yeah, see, that's the thing. I mean, I'm not a general.
Maybe I can answer the question. Let me just read a little bit up there.
Okay. I mean,
Okay, so basically, if you could just elaborate, is he shorting the market, or is he a covered call? Basically, is that you have a call,
yeah,
and you own the underlying somehow. Now, typically, a covered call is where you're writing a call, you're writing an option, so you're really thinking the market's going to go down from an option perspective,
right.
and you own stock.
Yeah. Okay. Just so you know, we broke up. Well, it is a pretty general question, Rakesh. If you can speak out, verbalize, because you are not muted. If you want to get more specific, because right here I'm just looking under Investopedia. Employee when an investor has a short-term neutral view for this reason, by asset long. Some like yeah, you guys can read it. Covered up call imply that own the underlying. Okay. I would start with a cover call. This is George. Hey, George, are you able to speak? Just type in yes, no. If not, this is just, I'm just restating this for people that were watching this and are not part of this. So let me just verify. Okay, so George says I would start with cover calls. For example, sell a call with a short expiry date, then put in order to buy the call back at a lower price. Cover calls can imply that own the underlying. Okay. Okay, so he's muted. Hang on, George. Let me get you unmuted. Just give me a second here. Okay. Go ahead, George. Yeah.
Well, when the calls with shorter expiry dates have a faster theta decay, that means that refers to the decay of time, decay of the option price with time.
Yeah.
So one strategy is to have a covered call with a short expiry date so that you can maximize on the decaying time, and then you put in order to buy it back before it, and hopefully with the volatility and the theta decay, you're able to buy it back and make a small profit.
Okay.
Yeah. So I mean, so this strategy is more of a some sort of market disequilibrium within the option world.
But you have
But
to watch. Sorry,
no, go ahead.
I just want to add. You would have to watch out for earnings and other things of the underlying that can dramatically affect the price.
Right. I'm not an option.
Yeah, neither am
I
I.
don't look at things from an option point of view. I do things in terms of spread trading in the futures market. It's a little different, but you know, when you write an option, you have a lot of risk.
Well, if you have a covered call, you don't have the risk because if the worst thing that could happen is that someone will sell the stocks that you own.
Well, yeah, I mean, right. You know, let me rephrase it. When you write an option that's naked, that's very high risk.
I don't recommend that.
Right, right. Now, when you have a covered option, then you're basically saying, well, what I own, I'm willing to risk all of it based on, some sort of market projection. So I don't know if it's a bad I would
It, it
because you're better fun.
sorry.
Well,
Go ahead.
if you if you bought the stock, let's say at $50, you're not gonna, and you write a cover call and the stock temporarily drops and you have this ordering to sell, and then it goes up to 55. Let's say it's 50. You bought the stock at $50, it goes down to 45, and then it comes back up to 50. If you had that ordering to sell, you could probably buy back the option when your stock temporarily goes down to 45.
Yeah, I mean, I'd have to sit and think about it and look at the look. I mean, it's kind of like a calendar spread. Kind of a
Well, just so you know, Ralph came back and said depends on how the big difference between the stock price and the sold option. Any?
The options are more expensive if they're more volatile, so you'd want to pick an underlining that goes up and down a lot.
Yeah. I don't know if that helps out Rakesh. I think that was a pretty good answer. Okay, so here Jeff comes back. You need to delta trade a book of options to make money. That totally makes sense. Hey George, I'm gonna put you back on mute, okay?
Okay.
But thanks a lot for the feedback. There's a lot of feedback here. Yeah. Okay, so Ralph came back and said, how long do you want to have the option? So if Rakesh wants to come back with an answer on that. This is good. We're having good dialogue here. I'm actually learning a lot, and hopefully everyone else is learning here. If Rakesh wants to type away. I'm going to assume that was a good dialogue there. Who else got a couple of questions? Can be pretty well anything about round trading. That's what we're here for.
Well, I just wanted to express to elaborate a little bit more on this covered idea.
Yeah.
In my dissertation, I'm going into the futures market and dynamically hedging in the options market. All right. Now, you know, I've always used options as a way to hedge a position. I've never used options in terms of, well, there's a change in some sort of decay factor of one of the Greeks, and because of that, then there's some sort of arbitrage between either similar option contracts or the difference between the calls and the puts, and all those dynamics. I've always thought of, and even in my MBA, we always were taught to use the option market as a hedging strategy, which is a little bit different than, looking at it from, well, there's disequilibrium in the system, and you can make a profit in the option market because of that disequilibrium. Because of what George, I think it was George that said this, or, uh, because of the change in the decay of theta, or, you know, so I think it's a difference of market philosophy and how to use options. I was just trained, at least in academia, in terms of options, to use them as a risk management tool, not a tool. It's to mitigate risk, not a tool to appreciate capital. Now, I know people that are in the option game to make money. So I know that's true. I know that you can make money doing what you're saying. But I've always gravitated to the idea that options are more of a risk management tool.
Yeah, I mean, I understand that options is just basically a rich man's game.
A lot. I think it was Shalom a very previous webinar. Majority of the options expire, out of the money. Well, why is that?
Yeah.
The majority of the people that buy stuff in the option market aren't making money. There's only a few that are.
Yeah.
I mean, it's probably like a freeway distribution. So, can you know enough about the game to do it? Yeah, probably. But there's an awful lot of failures that are going along with it, and they're these failures are people that have been trading the option market for years.
Yeah.
So either they don't learn from their mistakes, or there's something inherently not conducive for capital appreciation in the option market when you start playing all these butterfly strategies and calendar spread strategies and butterfly duplicates and all of the other strategies there are. The only ones that I've known that have made money in the option market were the ones that stayed away from not writing options. They just bought them.
Yeah.
And they looked at the market and they said, okay, I think it's going to go up, so I'm going to buy a call. Yeah, if it's going to go down, I'm going to buy a call.
Yeah. Hold on, we just got somebody new coming in. Hey, continue, Paul.
So the only ones that I saw on the trading floor that were making money in the option market was not doing covered strategies or calendar spreads and all this, but they were going naked into the market.
Yeah.
They weren't writing. They weren't. When I say naked, I mean they didn't own the underlying at all, and they weren't shorting the underlying at all. They just bought a call or bought a put, and we were playing the month, that month contract.
Rakesh came back.
That's the only time that I've ever seen anyone make money in the option market repeatedly.
Right.
Yeah, you could make some money if you got some sort of covered strategy or butterfly things, inverse, and buy some to get a little, to sell some contracts to get a little bit of money, and then buy some contracts but you net money into your account. What you bought is less than what you sold.
Yeah.
And a lot of people think that they're making money doing that. And I think that the whole theory of arbitrage pushes to the point where these contracts, in the aggregate, are out of the money. And I think the empirical evidence shows it. If 80% of the contracts are out of the money, then 80% of the strategies and options don't work.
Yeah. Okay. Just to update, Rakesh said that he's he has a holding period of between 1 week to expiry and 3 months. Some other comments came in. George said, good to use options for insurance and hedging purposes. And Rakesh said 90% of options sell out of the money, so he agrees with that. We just got a YouTube link from George.
Let me give you another example.
Okay.
The portfolio that I managed for the Archdiocese how we do it is we have in the investment policy statement, you cannot short the market. All right, we get people that donate their money, all right, and we put it in this fund. You know, it's a large fund, about $50 million. And what we do is we have a diversified portfolio, but it is a long-term strategy. We don't short the market, we long the equity market. We buy different types of bonds as a diversification, so when the equity market starts going down, we have bond appreciation. So that's a diversified method for any downturn on the market, which is the same type of strategy of buying the S&P 500 index and buying a put at certain points in time where the RSI is extremely high and the MACD is extremely high, and it looks like there's going to be some correction or some mean reversion. Then you make some money on your put, you sell it, you've lost some money in your equity account, but you're not going to sell the equity account. You're going to let it come back up. So the money that you made on your put is going to go back in, and you buy the lower priced equity.
Yeah, George.
You basically kind of dollar cost average into your long equity.
Right.
By the money that's appreciated from buying the put that you made money on because it was mean reverting. You know, maybe it was way above the 50-day moving average, and you said, okay, I'm going to buy a put. It touches the 50-day moving average. You sell the put, you made money, and then you immediately buy more stock in the S&P 500, and it's lowered your cost basis, and then it starts to appreciate back up.
Right. Yeah.
That's the way. That's how to make money in the option.
Yeah. Because George came back. Some investors sell puts to buy a stock that they want to buy. Ralph said GLD made 100 million. Rakesh, thanks for the input. And Ralph came back, said there's an option trader that makes 105 million in the NDX, SPX, and RUT. Her story uncovered. Now, these YouTube links, I'd love to be able to check them out, but as soon as I enter them into the browser, it's going to...
I'm very curious to know that if you take a look at the individuals that buy the mini S&P 500 future,
yeah,
and people that buy the call in the option market for the mini S&P 500, I'm willing to bet the ones that play the futures market will make more money than the ones that play the option.
Yeah, because Jeff asked that. Does anyone play the Algo S&P 500 E-mini futures? That's Algo trade. Anybody? Ralph said pure options. Okay.
That's why I kind of, in academia and, using options as a risk for a long-term portfolio strategy, yeah, I mean, that's the way to go.
Yeah.
But in terms of like swing trading or day trading, I think the option market is just way too volatile to do that.
Yeah.
The ones that make the big money, they probably have lost big money more than they. So I mean, in the net, I'm not sure if are they net positive or are they neutral?
Okay, Ralph, just so you know about this lady, Karen, we call her Karen the Trader. I'll give you a link on her. She's been busted for, she made $190 million in profit in options trading. Somebody in my community has busted her for a bunch of frauds, so don't believe, I'll pull up the link for you. I just wanted to put that out there. Yeah, don't believe this lady. She's apparently a crook. I don't know. That's why I was attracted to options. And I knew you asked a question about machine learning. We'll get to that in a minute. Continue, Paul. Like, what are your other thoughts on that?
In terms of options?
Yeah, sorry, I didn't mean to cut you off there.
No. I mean, I'm just saying that I think that there are a lot of people that, that claim that millions of dollars in the option market.
Yeah.
Either they were being lucky or they lost so much money in the option market that they broke even. You know? But the only time where I've seen people actually make money in the option market repeatedly has been more of a, using some sort of using it as a risk management tool, or they, buy the call or buy the put, and they're swing trading.
Right.
There's all these other fancy strategies, bear calls and bull puts, and all these different things that they're out there, butterflies, inverted butterflies, and all that. I think all that stuff is there.
Yeah, and we're going to get into that in the next topic on machine learning. Just give me a second here. I'm just going to pull up the link here for Ralph on the Karen the Trader. Yeah, here it is. Okay, I know that there was a link put in from somebody about, I don't want to mention, he might be online. Nope. Okay, hang on here. There was, if you go onto the forum, my forum, and look, it's one of these 3 links that explains her story. I'm just gonna keep looking for it. But I do remember that there were some mentions on her. Sorry to do this to everybody here, just doing this live. Here we go. Yeah, so here we go. This is the link I'm looking for. There was some stuff about her being busted and some other stuff as well. But there was some talk of that. Hopefully I'll help out you, Ralph. Now, Ralph had... Oh, sorry, I just got something new coming in. I got to mute them. Sorry about that. Ralph asked a question about machine learning. What typical... I just got to get the exact question here. Hang on here. I'll give you my opinion on machine learning. Okay, so Ralph asked a question about, just looking for it, what model of machine learning is most used here. So I'll put that out to the group. Paul, you don't do any machine learning at all, right?
Well, we discussed this last night.
Yeah, exactly.
There's probably a continuum of what machine learning means.
Right.
Okay? Now, my dissertation uses artificial intelligence and reads endogenous risk and exogenous risk of the market using the levy process. I have something called a receiving horizontal control algorithm that reads the market, and it's doing a dynamic hedging of the oil futures and the Euro USD futures. Now, the endogenous variable is the parameterization of a certain window of the data set and parameterize the levy process. So the theory is that there's a probability of a jump diffusion based on periodicity, based on intensity, and based on direction. And that using Monte Carlo simulations, that kind of teases out for the next few periods if the jump diffusion is accurate. Now, the exogenous variable, whereas the artificial intelligence side of it, is looking at the LIBOR rate and the changes in the LIBOR rate, and based on the prediction within the levy process and this exogenous read of the banking stress in the LIBOR rate, it will change my dynamic periodicity. It's not, every 4 days or every 10 days readjust. It's because when there's banking stress, the market starts to sell off asymmetrically. So there's a wall of worry. The market climbs slowly but sells off fast. So So when you want dynamically hedging here, you need to hedge more often during the sell-off and hedge less often during the wall of work. So the dissertation is basically that. It's adjusting artificially, using artificial intelligence to adjust the dynamic hedge. So that's I would say a low end of machine learning on the AI side. The high end machine learning is where you start looking at pattern recognition. And this is where the conversation really that Brian and I had last night. The pattern recognition, I come from the philosophy of chaos theory. That's my theoretical framework. I think that the market is not in equilibrium. It's on the edge of chaos most of the time. And and that's why I always graph things and using volatility surfaces. It's like the best metric that kind of is to shed light on the chaotic aspects of the market. Okay? So for machine learning, I think the best way is not to use a mathematical function. I think it's better to just read telemetry of the market and to find out through agent-based programming, agent-based complexity science kind of stuff, and allow the agent to learn the market. And when the agent is successful, it snapshots all of the telemetry that it's looking at from the market and stores it into a table of successes. So when the agent over time has gone through many different simulations and has stored this pattern recognition, then you can now go live with the agent because it's been trained to read the market's telemetry, and the live telemetry is being read in, and the agent is now saying, oh, this telemetry matches a similar pattern that I've been trained with another set of data, and you gotta remember that the pattern recognition tables, might be very large. And when it recognizes a pattern, it says, okay, I'm going to buy or sell. And it does an automatic trade. But it has no mathematics. It's not using regressions. It's not using logistical regressions. It's not using mathematics to do it. Because I think that math is nothing but, especially in the social world, in the social realm, mathematics is only a loose description of the market, because the market is constantly changing. So the resolution of the market, the full reality of the market cannot be totally captured in a mathematical model, because the way the mathematical model is constructed, there is error. There's an error aspect to the regressions, or an error aspect to the parameterization, and those errors are non-normally distributed, so the mean isn't zero over here, and they're skewed. So that means that the error actually has loss of resolution of reality within the market. So I think machine learning, pure machine learning, has no formula.
Yeah.
In the middle. So if you try to model the market, so if you look at it as a continuum, you try to model the market as a pure Black-Scholes model, or a derivative of a Black-Scholes model. And that's your market philosophy, and that's a pure math model. And that if the market is above the prediction of the model, you short it, and if the market is below the prediction of the model, you long. That's basic quant. Alright? But what if the model is wrong in terms of being able to capture reality of the system? Which is highly probable.
Yeah.
Alright? So in the middle of the continuum would be a little bit more like doing a dissertation. It has 1 foot in the math world, 1 foot into the, 1 foot into the AI world. All right. Then way on the other side of the spectrum is no math. So you're purely doing pattern recognition. Because, for example, if you look at a bird, or if you look at a child that tries to learn to walk, or a bird that's learning to fly, it's not calculating a linear regression analysis of the way it's flapping its wings, right? It has a certain degrees of freedom, and it's learning by doing. But there is no mathematic function to it. Math could be used to describe it, but the entity, the agent that's actually learning, does not use math. And you compare that to anything in evolution, they don't, the rise of the amoeba to the primate, there was no math. But it's obviously an intelligent system. It can be described in mathematical terms, but those mathematical terms are going to lose resolution of the reality of the evolutionary process. So I think that the future of AI, artificial intelligence, or what I call AGI, artificial general intelligence, is that pure pattern recognition. And I think Dr. Kurzweil, you wrote a book recently about how the mind works, and he talks about this. Now, his specialty is more pattern recognition for language, either written language, voice,
Paul,
stuff like that.
Paul,
But yeah.
Go ahead. We got Ralph who chimed in here. He didn't agree to something. I'll just we got Jeff who says you correct him regarding the pattern recognition. Paul says he doesn't agree. If Ralph, if you want to chime in on something, I will say this about Ernie Chan is that I have been bouncing some ideas off of him. He's in the same mindset that he doesn't believe in machine learning either. From my perspective, I think there's an there's an element that you can use in machine learning. Right now, I'm just focusing on math just purely to learn. I'm too new at it. But if you want to add some commentary, Ralph, about that, just so we can understand what your perspective, or I can unmute you. Just let me know if you want to voice your opinion on this with Paul. You want to continue, Paul? Sorry about that.
Yeah, I'd be curious to know why you disagree. I mean, what part of what I said is you disagree? I mean, the basis that I'm coming from is that, again, I'm a chaos theorist.
Right.
So I believe that systems that are reflexive cannot be completely, the key word here is completely, mathematized. They can be partially mathematized, but whatever is used to mathematize a reflexive property is only going to be close to reality. It's not going to capture the full totality of reality. The mathematics in the cosmos, describing a cosmology kind of aspect of it, is much more accurate. Newtonian mathematics works really, really well. Why? Well, there's no reflexive property. But once you start getting into the social sciences, a system that's more social, where fear changes the dynamics of the system in unpredictable ways, it's very difficult to purely mathematize it. And because of that, there's going to be errors in the creation of those mathematical functions. That's why I think pure pattern recognition of the market is a better way if you're going to go through use machine learning.
Right.
Use machine learning that is trying to mathematize the system.
Right. Okay, so Ralph came back with saying it demands a lot of EXP LING, and I'm just trying to get clarification on that. Oh, say okay. Demands a lot of explaining. Would I mean, just from my perspective, Yeah, that's what he meant. But from my perspective, I'm putting that way on the back burner of machine learning. I might.
But here, this is the beauty of chaos, okay?
Yep.
A misspelling here, explaining,
Yep.
is fully explaining the point that I'm making. I didn't use a linear regression analysis to figure out what he meant by explaining. I used pattern recognition.
Okay. Well,
That right there is a perfect example of what I'm saying.
right.
I didn't run a math model to understand what he meant.
Right.
There was missing data within a system, either because of a hiccup of the way the system is created, or there's something unique about the dynamics of the system where the telemetry isn't showing up.
Yeah.
Pattern recognition would fill in the blanks, while a linear regression analysis or some sort of pure math model would blow up.
Yeah. Well, you got a fan here in John who says, I agree 110% with Paul's. Mathematics and trading can only go so far. Paul's approaches are groundbreaking because they are more leading edge than anything that others are doing. So there you go. George said the word keeping or sleeping is another pattern recognition example. Exactly. Okay, so I guess we've talked about that one. That was a good one. I think it was George. So George asked, what are the most popular languages in the quant field? Well, for me, I'm looking at Python. Python is good for newbies and starting at zero budget. There was a link I loved about Python. Actually, let me just pull that up. If I go into the blog where it says, I'll just type it up for you. There was a comment about Python being a trap, because right now I'd say Python is the #1 language right now, but there is a lot of talk about that Python brings as a disadvantage of using. I'll just say that and let you guys read that link and explore that. Python is slow, George. Yeah, that's great because it is an interpreted language. MATLAB, Octave, RBattle. Again, the R is in the same boat as Python because it's open source. I can show right now some MATLAB demos, but it will probably be taxing my system pretty good. But I like MATLAB. Just you can rapidly generate your trading ideas. You can rapidly code generate to C or C++. And that's it. But I'll leave you with this on my exploration in F#. I'm really excited by this language. Paul's talked about agent programming. This YouTube video by this guy Phil Trelford of F# and trading walks you through the real big advantages of F#, and there's a huge movement towards it. And just so people know, the one place I go to always track popularity of languages is a site called Tiobe. Let me just hang on here. And this programming index is quite good, which will show what's popular, what's not popular. Let's say the top 10 languages, you got C++, Java. C's gaining speed again. Python's kind of still hanging in there. But the one language I'm watching is F#. It's got a little double chevron, and that's a really hot language. Python is still, or sorry, MATLAB's still in there somewhere. MATLAB, R is way down here somewhere. So it's a good indicator of what people are using. Hopefully I'll answer your question, George. Go ahead, Paul. Paul, go ahead.
Okay, for me, I like MATLAB a lot. Now the reason why I like MATLAB is it has a lot of toolboxes that you can play around with.
Yeah.
And it's a commercial product, so it's been vetted. There's a quality aspect to it that you might not see in R or Python. But you know, it's an expensive piece of equipment. Now, what I also like about into C++ or C sharp. Now, so the languages that I kind of like to play around with, I haven't done the F sharp. I got to look into it.
I've never either. No.
So, but I like C sharp a lot, and I like coding in MATLAB. But I'm also moving things into a VR world. I'm moving things into a virtual world, and the virtual world engines are using JavaScript and C sharp, at least the graphic engine that I'm using. So, for a Windows-based environment. For a Mac-based environment, because I work on both systems, for a Mac-based environment, it's still MATLAB, but obviously it can't be the C sharp.
No.
So that's more of like the C, the Object C stuff. Now the problem with Macs for quants is that I don't think there's as many tools, as many user groups, as many resources to learn from as it is in the Windows world. So there's that that drawback for Macs. But in terms of power of the language, I think that anything that's in Mac is going to be just as good as anything that's in Windows.
Yep.
But it's really preference. But for me, it's the core of what I do is coming from a scientific point of view. And I think MATLAB is great for those types of research. And then when you want to go into the production phase, then you start moving more into maybe an F sharp, C sharp, or the Objective C.
Yep.
That's how I play. I stay away from R and I stay away from Python. I just think that MATLAB is so good.
Yeah.
Why even? I mean, it's like driving. You've driven a Ferrari. Why would you drive so that's not just fun. Now there was a question that someone had. John had a question here saying, have Paul talk about how he envisions the VR experience.
Yeah, I was just going to get into that. Can I just say something, Paul? Just so people know, let me just run this on the screen here. This is Paul's software here that gives, let's say, a surface plot in real time. So he's working on this solution to visually see the market in a virtual reality type of view. So this is some of his demos that he's got on his YouTube. I've already put the link in there of this software, and it's all done in MATLAB. So just wanted to highlight that so people understand what Paul's been really working on with when they say, or when John says the Poseidon approach with his software. Sorry about that, Paul. Just continue.
Yeah, okay. So with the surface that's on the screen, this is showing time, for the ones that don't know, it's showing time, a correlation to the S&P 500 in oil using a 5-day window, and showing volatility of the S&P 500. And so I like mapping things in volatility surfaces. So that allows me to do my spread trading in the futures market better, because when there's volatility, the spreads change. So I like seeing things in a three-dimensional way. Now that might be because I used to be an automotive designer, so I think in 3D, but that's kind of how I trade, right? And that's the development of the site. Now, to answer John's question about VR, what I envision for VR experience with visualization, I did a webinar last night that sort of highlighted, but I'm going to be doing another webinar in September with Brian, and I'm going to be talking about something called hypercubes. Now, some people may know what a hypercube is, some people may not. But basically, a hypercube is looking beyond 3 dimensions. And so you can go to a 2 to the fourth power, or 2 to the fifth power, or 2 to the sixth power, and they'll give you more dimensions. Now, hypercubes are really used for string theory and end theory, which is more cosmology. It's more to explain the universe in the early origins, and explain at the fundamental level what's going on in some common particles, like quarks and gluons and stuff. What makes that? What's the property of the gluon? So that's what hypercubes are for. Right? Now, if you look at the people that have traded the market for a while, they start accumulating more and more screens, more and more charts, more and more telemetry. And that means that for every variable that you want to look at, it you're building up a list of variables, or what I call the telemetry set, and you'll need more screens to see them. And typically, someone looks at a price chart, it's time and price, and maybe some indicators or some moving averages and whatnot, but it's a 2D, all right? Well, this screen that Brian has shown here is going one step further and pulling out of the price chart the volatility of the price and showing it in 3D, all right? But when you take it to the hypercube level, I can now go and say, well, I don't want just correlation, time, and volatility. I also want to know the log return. And then, so that's 4 variables. Well, I want to see a 5th variable. Let's say I want to know the drift of the component, because you like to see things more like the Black-Scholes model, where it's drift and volatility. Then I could have a 6th variable, say, that's some sort of jump diffusion function that's being calculated. So a hypercube is seeing the market in a lot of different variables.
We now
And
have
so I'm trying to use hypercubes and this concept of virtual reality to bring the market into a VR world so you can walk around the telemetry. So you have a lot of different three-dimensional charts moving. They could be bar charts, they could be surface plots, like you saw. It could be news telemetry. It could be also not just like an RSS feed of news, like you would see on a Bloomberg, but you could also have a histogram of the news that's coming in, which is showing the intensity of the news or the type of news that's coming in. Is it positive or negative? What's the frequency of the positive or negative versus time? So you could do all this statistical analysis on just RSS feeds and see the market in the VR world, because you have infinite amount of space. You don't have infinite amount of space on a trading room, right? You only have a certain amount of space on your desk. The max that you can really have is about 8 screens. I have 6. So, but I really need 20 to 30. Because of the way all the assets, I trade about 20 assets. So, and all the different charts for those assets. So I need about 20 to 30 screens. Well, I don't have space for 20 to 30 screens in my trade. So I need VR to be able to build all these different telemetry screens within the VR world. But it doesn't need to be just a flat plane in a VR world. It could be a 3D. It could be a 3D cube that you're walking around in a VR world. So that's what I'm trying to develop, is bringing what I've done in Poseidon in MATLAB and bring it into a graphic engine that is, I'm using Unity 3D, which is a software that is primarily used for gaming. It builds deep virtual games, but I'm bringing it in, and the way I'm parameterizing the surfaces and all that using C#, bringing in that data into the VR world so I can use and have the ability to roam around in this virtual world of the market and do my trading. So that's the what I envision. That's the goal that I have with it's a challenge. It's revolutionary. It's, you know, and it's a collaborative kind of thing,
Yep.
effort. But that division of Poseidon, and that's how I see the future of VR in finance, or what I call topographical finance.
Yeah, just so everybody understands, I've been looking at Khan Academy. I'm just right now doing linear algebra. I'm not sure if this is related. I'm no expert in math, but the question is here on linear subspaces. So if you're in reality of R1, R2, all the way to Rn, this is applicable to Paul's point of view with his Poseidon software. But this is done mathematically, so if you want to check out a YouTube video on just from a linear algebra perspective, this is a good video to watch, and really explains it quite well. Just thought I'd put that in there.
Yeah, if you go to Wikipedia,
Yeah, okay.
type in hypercubes.
Okay.
I want to just kind of show what I mean. I'm always trying to look at the market in 3D. You can't see really the market beyond 3D. You can kind of see it in 4D by showing movement.
Right.
Right? But you can't really grab 5D, right? But we can think about it mathematically. So if you look at this moving cube, you scroll down a little bit.
Okay.
You scroll down a little bit, you'll see this
What am I looking for?
No. Go up.
Okay. Right here?
Right there. Yeah. So now you have a cube, all right, and there's a cube within a cube that's created. That is a tesseract, and that is a four-dimensional hypercube. So if you have 4 dimensions, then you'll have this four-dimensional hypercube. And what that basically means is that you need stop. If you can stop it, I don't know if you can freeze it.
Yep. No, I don't think so.
Okay. Well, when it forms the hypercube, all right, the four-dimensional hypercube, it has 3-dimensional spaces. There's 8 3-dimensional spaces in a 4-dimensional hypercube. So if you have 4 dimensions, when you use the hypercubes, you would have 8 different Poseidon 3D charts. Now, they're oriented in such a way that it's only 4 different state space of a 3-dimensional state space. But, so basically, if you have 4 dimensions and you want to graph the 4 telemetry variables, you would use a 4-dimensional hypercube, and you would use 4 3-dimensional spaces that are all unique within Poseidon to map the market. Now, a more interesting market is probably going to have a telemetry set of probably 8 or 9, maybe 10 telemetry points. And you can use these telemetry points for the machine learning for the agent-based modeling that I was talking about earlier. So Poseidon in the virtual world isn't just this visualization technique to see the market in these different 3-dimensional cubes of a hypercube, of a 10-dimensional hypercube. It's also to be able to take the telemetry points, put it into tables, pattern recognition tables, the matrix, and will allow agent-based modeling to take over for decision making in terms of buying and selling. Now, you could technically say, okay, I just want the thing to automatically trade, and I can walk around in this environment, this VR environment, while it's trading, and let the agent make my decisions, and I just oversee it. Or you can dial it back a little bit, where it says, well, I wanted to make a decision, but I wanted to say, okay, do you want to trade or not? And you could have a screen that pops up in the VR world saying, oh, the agent has made a decision that you should trade, do you want to trade or not? And then you would say yes or no, and then you would execute the trade. All this would be fed out of the Unity 3D
Uh,
Hopefully that makes sense. I mean, this is kind of revolutionary stuff, but hopefully that makes sense to people.
yeah.
But you can see in this hypercube that there's cubes, there's a cube within a cube, and what connects the cubes are other three-dimensional spaces that are skewed.
Okay, we got some commentary from Rakesh. I don't know if people have seen this in the chat box, but he was referring to there's a great Nova documentary about what Paul was talking about before. Math formulas do not take into consideration traders' irrational exuberance, and there's a PBS link in there on that.
But I just want to make one statement.
Yeah, go ahead.
You see on the screen that there's some mathematics to define a hypercube,
Yep.
right? But what I describe in using hypercubes with Poseidon within a VR world doesn't need any math.
Yeah.
All it is taking is just parameterizing a surface from telemetry of the market, and you're just looking at it. Again, it's about pattern recognition. It's about visualization. That's how our mind works.
Yeah.
We have a very, very low cortex, developmental cortex for mathematics. But we have a very, very complex cortex for imaging process. There must be an evolutionary reason for this.
Yeah. Well, we're waiting on a commentary from Vlade. I hope I'm getting your name right. Sorry, man. He says there's a demo video surface on MathWorks using Surface Algo for trading. So we're just waiting on him. Steve came back with a comment saying, I see math as a language, the most common language for quants. The state of multiple dimensional math art is mostly successful trying to explain linear and relatively stationary phenomenon, or trying to explain more complex non-linear phenomenon using piecewise using piecewise linear approximation. Nowadays we are limited to talking with computers using math as a language. We use math to describe how one pattern is close to matching other patterns in some kind of multi-dimensional metric space. So I would agree that machine learning is still severely limited in its potential, mostly by our inability to explain reflexive feedback, generate non-linear dynamic interactions using simple, neat, linear mathematical descriptions of what patterns are happening. That's quite a bit more. You want me to keep going? Linear subspaces are an example of how we attempt to simplify complex multi-dimensional phenomenon with piecewise linear approximations.
Well, yeah, the key point here is really the last sentence, and that is they're linear approximations
Yeah.
of a reality that can't be fully captured in mathematics because there's a reflexive principle within the system that's trying to model. That's why, this kind of parlays into what George says, that, that I'm trying to turn my software, turning trading into an art.
Right.
The state of the art, the terms that we use in a society is a good indicator on how reality is. All right. And what I mean by that is art. Sometimes people say, well, art is more it's for the creative people. It's the right side of the thing instead of the left side, and then the ones that are into mathematics are the opposite.
Yeah.
I'm looking at what's happening in the real world. How does these creatures that live on the earth have evolved? None of them use math. So to me, it just seems the future of AI or AGI is the less math it is, probably the more realistic the way that the neural cortex is developed.
Yeah.
Now, to add a little bit to what George said, yeah, there is something mesmerizing about looking at a volatility surf in 4 dimensions and watching it. You get a rhythm of the market. Brian and I have been talking about this since January. wants to be able to monitor it, you know, to the point where I can use it for trading. But, you know, that there is an art to it. There, you know, but it's it's using our ability to pattern recognize and trying to use some of that pattern recognition and how we see things and programming that into an agent-based model.
Yeah, okay, so just exactly talking about that, this is a book on the Microsoft site with F Sharp, server-side programming with F Sharp agents. So it's the same concept of what Paul's been mentioning here, where basically, for instance, you have a data feed live real time, but then you have individual agents that are programmed in a way for event-based or event-driven based, where you can have each agent react, and then you can code that up to do whatever you want, as Paul would say, a trading decision or whatever it is. But this is a good resource to work from, and this is one of the only languages I've seen that is capable of that. And just putting that out there just so people are aware of why I have this fascination with F Sharp at this point.
Well, I think that there's probably a lot of capability within F Sharp. Yeah, you know, I just have to dive into it a little bit more.
Now, George came back with, have you tried your software on the VIX? I'm assuming for you, Paul, and Poseidon. I mean, there's a response.
I haven't used it on the VIX. Again, I primarily trade the currency market and the futures market in nat gas and in oil. All right. So I parameterize my surfaces based on those assets that I trade. But there's no reason why you can't. You could do the same thing. What's interesting about the VIX is it's a volatility index of the S&P 500. Now, but what you would do, what's interesting about mapping the VIX is that you're mapping a volatility surface of a volatility matrix, of a volatility index.
Touche.
So you're seeing the volatility of volatility. So it'd be an interesting thing to do, but you could use it. And again, Poseidon doesn't necessarily have to be volatility as the Z variable. It doesn't have to map volatility at all. You could look at price, you could look at drift, and you could look at correlation, or you could look at price, return, and time, or whatever you want in whatever three-dimensional space you want to look at. Now, I don't know if Brian wants to go to my website.
Yeah.
So they can download Poseidon if they want to, but I have Poseidon. I have a beta version that produces a probability curve, a PDF curve, and a CDF curve, which is the beta version of Poseidon. And I have a light version of Poseidon where you can load up any three-dimensional matrix and you'll graph it using a biharmonic surface fitting. And I also have the 4D beta version. So you just go to that product and decide product.
Put the link in. There you go.
Right. So you can just read this web page and download the links, and hey, it's free. Play around. So George, what I recommend is just take the data set of the time period you want to look at for the VIX and put it into the Excel sheet that's in the Poseidon Lite version, and you'll see that three-dimensional matrix surface, of the VIX. You probably want to use time. You'd want to use the VIX, actual VIX indicator level, or value, if you want to call it that. But you have to pick another value, another variable that you want to measure it to. You might want to measure it. My recommendation is to measure it with probably return, maybe long return of the S&P 500 as your third variable. And that would be an interesting thing to do. I haven't done it, but I would time for X, I would do for Y dimension, I would do probably log return of the S&P 500. Then the Z dimension, I would do the value of the VIX index. But you can download it, and, play around with it, send me an email of the surface that you created, or you screenshot or whatever, and we can talk about it.
Yeah, we got some. George asked a question: where can you get VIX data? Let me just see.
From Yahoo, doesn't it?
Yeah, no, but he's probably wanting raw, like tick data. So I know you can get it from the IQ feed. He's there. He's saying confirm, so I'm assuming that's good. Hang on here. Ralph had a still tradable future and options. I'm not sure what you're referring to, Ralph. If you want to come back and rephrase that. Yeah, so George said log. I'm sure you can see all this. What I got here, right? Paul.
Ralph's saying VIX still tradable futures and options.
Oh, I see. Okay.
I don't trade the VIX. I've always used the VIX. When I was on the trading floor, the proprietary trading floor, which is how I learned all this stuff. We use the VIX as an indicator when we were trading our equity. I specialized in trading three different equities. It was a day trading shop, and I was trading JP Morgan, Morgan Stanley, and ConocoPhillips. So those three stocks were on my screens, and one of the indicators, there were many, but one of the indicators that we used was the actual VIX. And the thinking was, at least in the day trade world, is that as the VIX was starting to increase in volatility, that's a measure of the movement of the overall market, the gauge, the fear gauge of the overall market. So that would translate into the move in the individual equities. So if the stocks that I was trading, they were more risk-taking stocks, right? They weren't like utilities or anything like that. They were safe haven stocks. So when the VIX started to spike, then normally you would see a downturn in the intraday movement of the price curve, and when the VIX started to abate, then you start seeing appreciation of those price curves in those stocks. So that's how we use the VIX on a trading floor. I never traded the VIX. I thought you could buy VIX options.
So anybody else got any questions that have just joined us? Just type them up in the chat box. We've covered quite a lot of topics tonight.
So now George had a question about where did you get the VIX?
Yeah, actually, I just put that. If you're interested in the symbol, the market volatility VIX.xo at the symbol guide here for IQ feed, and that's gonna be what 3 milliseconds off the real time. That's pretty good for $100.
Right. Now I think, for George, if you need the high frequency data set, this is one great way to get it. All right. But if you don't need that high frequency level, then I think the St. Louis Federal Reserve has also the VIX index, but those are really close, adjusted closes.
Yeah, you're right.
So you could download that, but that's a low frequency, that's day level. But if you're doing options, if you're trading options, that's good enough, because you're not going to do high frequency trading options. No one does that I know of.
Yeah.
Without killing the portfolio. But so it really depends on the kind of trader that you are, and on what frequency level the data needs to be before you put it in the site. But I have a feeling that you need probably a lower frequency level set of data, and probably the Federal Reserve is good enough.
We got some questions here. Hang on, let me just see. We got some background noise here. Hang on, Steve. I'm just muting you. Sorry, no, you just joined us. So George followed up with, so increase in VIX imply lower stock price. Is that increase? Is that increase would start with St. Louis in data, and can you provide that link? Yeah, I'll put that in there. Hopefully I'll help you out. Now Vlade came back with an old webinar from Matt Works about MATLAB doing the surface plot. Question to him was it the automated trading webinar, the algorithmic trading webinar you're referring to? Just give me a yes or no and I can give people some. Oh, we just got the link here. Hang on here, let me just pull this up. Thanks for the info though, Vlade. I would not be surprised. It's going to be probably what I'm thinking. Yeah, if it's from, okay, yeah. So this.
Oh, and welcome to the webinar.
Yeah, here.
Algorithmic.
So yeah, these two algorithms. If you're wanting to learn how to build a basic trading platform, automated or algorithmic based in MATLAB, this webinar is excellent for that. Yeah, Vlade pointed that out. Hang on here. We just got two things going on at once. Okay, so there's this one, which is the algorithmic based trading, and I believe, give me a second here, MATLAB automated trading webinar as well. So there's two algorithmic based and automated trading. People don't know that, but there's this link as well. So there's two separate webinars, one on algorithmic based trading and algorithmic based trading and automated trading. Okay, so there's two separate webinars. Good starting points for anyone who wants to know how to build trading platforms with MATLAB. And also covers a connection into Fix as well. It's all, if you have MATLAB, this is all free, which is awesome. Paul, is there anything I inadvertently cut you off from?
I just wanted to say to George that when the VIX increases, it does imply the lower stock price. And then when it goes down, then it's going to increase. That's how we did it on the day trading field. But you know, if he downloads the Poseidon software, you know, pulls the data set from the St. Louis Fed, puts it into the Excel sheet that the Poseidon software reads from, then he'll be able to create the surface and look at it. Once he does that, I'd be very curious to see what he did, and if you could share that with me, either send me an email or you can get me on Twitter or whatever.
Yeah, your contact's here though, right?
Yeah.
Yeah, it's just under about.
Yeah, down at the bottom. Contact.
Oh right, yeah, contact right there. I'll just put your site in there for everybody.
So I just, once you do that, George, let me know, and then we can, collaborate, and I can show you, maybe how to tweak it for your particular trading strategies or your particular trading method.
Because George came back with a comment saying, sorry, I'd like to start with data from the St. Louis data. I'm not sure what you're referring to.
Well, it's the St. Louis Fed data the link you gave.
Yeah, so that's...
This would be a good start. This would be a perfect start. It's free data, and for option trading, day data is good enough.
Yeah. Vlade gave me a note here about to scroll on that webinar to 2024 on this plot, the 3D plot demo that he was referring to. So just take note of that. Hopefully people can see that in the chat box. But again, those are really good starting points for anybody wanting to build an automated system. I wouldn't recommend going live with it, but it is an excellent starting point to learn how to build something in MATLAB. We're coming up to 8:30 or past 8:30. Anybody else like new that wants to ask a question, the Paul board or a comment regarding technical trading? We've had some discussion about the economy. Anybody? Because we've covered quite a lot of stuff tonight, and this is recording, and I'm hoping this file will make it at the end of this so we can get it up on YouTube.
I did want to say one thing. I'm having another webinar with Brian.
Yeah.
About mapping the bond market in deciding. I think it's on the 27th.
Yeah, I'm going to pull up the schedule. Let me just pull up the R one, the R group. So, what was it? August 24th. This one, yeah, modeling yield structure in 3D.
August 27th.
Yeah, I'll give you guys the that meetup link. And you're planning to do another one on September, was it 9th, right?
Yeah.
Yeah. So you've been a busy boy.
Yeah, very busy.
Yeah, you
But I just wanted, the people that are on this webinar that may want to see the longitudinal study in the yield structure of the bond market, even if you're not a bond trader, even if you don't buy bond indexes, you'll still benefit from this webinar because you can use the telemetry of the yield structure in the bond market for your trading decisions in an algorithmic trade. Because when you see changes in the structure of the yield curve, that's changes of the economy. That's changes of especially in the front end of the curve, stresses, the stresses in the funding of the economy and of the banks. So, and the changes with the intervening of the Federal Reserve and how that affects the overall economy. So you can use this data as part of the telemetry to make decisions for either a pure model environment or a more pattern recognition environment that we were talking about earlier. So it's not just for bond trading. No, I mean you can use this as telemetry.
Jeff just reported he's an ex-bond trader.
Well, we should see the letter.
Yeah, or let us know your experiences because we don't have a lot of people that have been involved in fixed income.
Right. It's especially in the mathematic realm, the modeling of bonds, that can get really deep.
Oh yeah.
There's a lot of math behind it. But it sounds like it's a boring field, but it's not. I mean,
Well, when
a lot of the quant innovations came out of the bond market.
Well, it'll be useful for when the markets start to tank, which we already covered earlier tonight.
Right.
Yeah, if things get out of whack. Anybody else got any questions or comments? Been just on for an hour and a half recording wise. Anybody got any questions? Paul, you got any questions at all or comments or any queries for people? No? Anybody got any questions? Because we can wrap it up pretty soon if you want. And I'll post this on YouTube for other people that may have missed this. Because we'll just do it going once, twice, 3 times, and then we'll just end up the webinar. Like I said, I'm hoping to do this on a much more frequent basis, maybe even a weekly basis. I mean, this is a good group. I learn a lot out of it. Hopefully, you guys get a lot out of it, and it's a great thing to do, on a frequent basis. So, anybody got any comments, questions, queries? Yeah, Vlade says great stuff, Paul. And thanks. Anybody got any other questions or comments? Thanks to everybody for making this a really good webinar. Hopefully everyone took away some knowledge. Too many questions, not enough answers. Yes, that is true, Steve. Thank you, thanks. Let's do it again really soon. Hopefully everybody can be part of this, and hopefully I want to say thanks to everybody who's contributed. Rakesh, for that link on the PBS documentary. That's something really I'm going to take a look at, and some other stuff that came out of it.
Brian, I was just thinking that if this is going to be a regular thing, maybe if people post some assets that they may want to look at.
Yeah.
Signing,
Yeah.
and, you know, either maybe they could put it in their own copy of the site.
We could talk about it.
Share their, you know, that plot.
Yeah.
And what, you know, how they're using it, or if they want me to, you know, maybe look at something, and create it, and, you know, we can discuss it, you know, in the webinar.
For sure.
Maybe that helps, and maybe not, or we could do something else, maybe just a price curve chart of particular asset.
That's the whole.
Just go around the table, you know, and say, well, what do you think? You know?
Yeah, I mean,
that's just a thought.
no, I think that's a great idea. Anybody got any feedback on that one? I think that's. Lay came back with, by the way, I bought your 2 books last night, a bit fresh, AIR. Really? I appreciate your view, all these acronyms. I'm an old man, I guess. Yeah, it's good to hear. It's like I told you, Paul, you're building a brand.
Yeah, well, it's been a long journey.
Oh, yeah. Well,
Great in 2009.
yeah, yeah.
It's been and that was when it was, the VIX was really high.
Yeah.
So, you know, so my, you know, my baptism by fire in trading, I guess, you know, was during the, you know, the whole, you know, crash.
Yeah.
So that's kind of why I've always looked at things from a volatility perspective.
Right. And unfortunately, there's not a lot of volatility out there.
Yeah, but, you know, it's all volatility growth. It's like pain.
Yeah.
If you're used to a lot of pain, then if someone pricks you with a pin,
Yeah.
then it's a big deal. But if you're not used to pain at all, and then someone pricks you with a pin, then you're excruciating pain.
Yeah.
So volatility is also relative to the other volatility,
Yeah.
previous volatility. So it's not absolute volatility that's important, it's relative volatility.
Right. Touche. Yeah, George says option prices are very volatile.
Yep.
Anybody else want to add anything or feedback, questions, comments, queries at all? Okay, well, let me do the going once, going twice, going 3 times. I guess we have called it a night. Thanks again for everybody coming out, and hopefully we'll see you on the next one. Just keep your eyes peeled on the meetup.com and the Quant Finance, this group. I'm sure you guys already know. And this group as well. I run 2 meetups. So John says all the best to everybody. Everyone, George says good night. Again, thanks a lot for coming on out. I'm going to end the recording. Thanks a lot, Paul, for contributing. Without you, a guy like you, I wouldn't be half as far as I am, or even a tenth of as far as I am.
No problem. We're sharing.
Yeah, exactly. All right, let's give her a wrap. And thanks again for everybody coming on out. I'll put this video up on YouTube. And again, thanks again, Paul. Have a good night. Have a good night to everybody. And I'll say over and out. Have a good night.
Right.
Later. Bye.